in good news with finance stuff. Stock market has been breaking records over and over again. Broke another record today. Cha-ching! If you're watching this later on, folks, then it might not have done that. But today it did. So, broke a new record today. Things are great. Part of it was inflation came in. CPI, the Consumer Price Index, came in with the inflation results. They weren't fantastic, but they were better. I mean, it's getting better, and the Fed's people are starting to signal, or the Fed's starting to signal, and people are starting to get the sense the Fed is going to lower rates probably sometime later this year. People are hoping by June, and that's what we're going to watch real quick here on Yahoo Finance.
Well, investors are eagerly awaiting the latest read on inflation and what it will mean for the timing of rate cuts. CPI for the month of February is out Tuesday. The headline number year over year expected to remain unchanged from January. But core CPI, excluding volatile food and energy prices, is expected to soften a bit to 3.7%, slight decline from January's 3.9% reading. Here with more, we've got Citi economist Veronica Clark. Veronica, great to see you here this morning. All right, so the expectations are laid out. What, though, will this mean for the pathway for the Fed here, and what data dependency and the trend that they're looking for in that data is actually signaling?
The most important thing that we're watching at 8:30 tomorrow morning is the month-on-month change in core CPI. So the year-on-year rate should be falling, but we're actually...
So what this was yesterday, sorry. So what they're looking for economically was people were looking for, okay, if it's going... It looks like it's coming down, then it looks like the Fed is probably going to ease up on the rates and probably move it back, which means housing rates will go down, car loan rates will go down, all loan rates will go down in general, right? Which would also be a big boost for the stock market, which is already breaking records. Well, skip forward from then to today, and let me get over this. I should have teed this up better, but I didn't. But here we go. So today, this is what happened.
Rick Santelli is standing by at CME in Chicago. Rick, take it away.
All right, our February read on the Consumer Price Index headline number expected to be up 0.4% is up 0.4%. Now, if we look at the most recent lower number in this series, we had 0.3 in January, and we had 2.2s in November and December. So this is now a firming issue as we've had back-to-back reads. We had up 0.4, now ex-food and energy also up 0.4.
So basically did what we predicted it was going to do, which is rare. Typically in finance we don't usually expect our predictions to come true. We're just hoping to get close, right? Well, I mean, you can't predict the future, I mean, and you can't get every variable, so
right. Every once in a while when you go, oh.
Well, I got to tell you, if I ever do a forecast and it ends up being perfectly right, I'm going to go back and double check it and figure out what the hell went wrong, because there's no way I'm hitting the number exact. I have a better chance of winning the lottery than hitting the number exact. But yeah, so basically it's down from what it was from last year, inflation, and it's down a little bit from last month, so 0.4%. But that's a lot. That adds up over a year, right? So it only rose 0.4%, sorry, which is what they expected, but it is still cooling down. It should raise some. It's always going to raise some. If it's going down, we've got a problem. If you have a negative inflation month to month, it's bad. But yeah, month to month did what it was expected. Everything looks good. I mean, I know the Fed would prefer it around 2%, but right now it's around 3.2%. So yeah. So right now, if you guys you're in the market or you're looking to retire, this might be a good time, or right after the election might even be a better time, because if it looks like Biden's going to stay in again and do another 4 years, it looks like it's going to be a pretty tame 4 years, which would be good to retire under. You never want to retire when the market's bad. You'd rather it be bad later in your retirement if it's going to be bad, because early in your retirement, when you start taking that money out, if it's bad, you don't have the growth time for the rest of the money, and you lose a lot. So it bleeds out quicker. So yeah, you want to be careful with how you invest in the market when you first retire, especially when you retire. So, but things are looking good now. So it might be a time. If you got a financial advisor, I'd go talk to him. If you don't, I'd go get one. So and see what to think, because not a bad time for the market if you're going to retire. I know my
that sounds like a good for a whole lot of people.
Well, I know all my retired clients are freaking ecstatic right now. I mean, in fact, they're way up. I mean, they're so far up that it's like they're like, well, I was expecting to spend this much this year, and it's like, oh shit, I already made that and more. So I'm not actually dipping into what the initial principle we started the year with was. So, yeah, playing with the casino's chips at this point, which is always what you want to be doing. So, yeah. So that was that.